Hello everyone. Welcome to the channel. If you're thinking about investing, you've probably heard of stocks, bonds, and mutual funds. But do you know the real difference between them? Which one is right for you? Making the wrong choice could mean losing potential gains, or worse, losing money. But don't worry. Today, I'm going to break down what these investments are, how they work, and which one is best for you. Let's get started. What are stocks, bonds, and mutual funds? Let's first briefly analyze each investment type. Stock, equity. When you buy a stock, you are buying a piece of a company. This means you own a portion of the company's profits, and your investment grows as the company grows. For example, if you had invested in Amazon in 2001, your investment would have grown over 500 times by now. But stocks also come with risks. If the company performs poorly, the share price could drop significantly. Bonds. Bonds are like loans. You lend money to a company or the government, and they pay you back with interest. For example, U.S. Treasury bonds are considered one of the safest investments, because they're backed by the government. On the other hand, corporate bonds might offer higher returns, but come with a greater risk of the company failing. Mutual funds and ETFs. Mutual funds and ETFs, exchange-traded funds, pool money from multiple investors to buy a mix of stocks and bonds. Think of them like a basket of investments, managed by professionals. Instead of picking individual stocks, you buy a portion of the fund, spreading out your risk. For instance, an S&P 500 index fund lets you invest in the 500 largest U.S. companies at once. Risk and return comparison. Now, let's compare these investments based on risk and return. Stocks, high risk, high reward, great for long-term growth but highly volatile, can lose value quickly in a downturn. Bonds, low risk, low reward, offer stable returns but lower potential profits, best for conservative investors or retirement planning. Mutual funds and ETFs, medium risk, medium reward. Diversified investments mean less risk than individual stocks. Some funds focus on high-growth stocks, while others aim for stability. Which one should you choose? So, how do you decide where to put your money? Here are some general guidelines. If you want high growth and can handle risk, go for stocks. Young investors with a long time horizon can afford short-term losses. Look for solid companies with long-term potential. If you want steady income and lower risk, bonds might be your best bet. Ideal for retirees or conservative investors. Consider government bonds for safety or corporate bonds for higher returns. If you want a balanced approach, mutual funds and ETFs are a great choice. Index funds like the S&P 500 ETF provide long-term growth with diversification. Actively managed funds allow professionals to handle your investments. For the best results, diversify. A mix of stocks, bonds, and funds reduces risk while maximizing growth. Example, a young investor might go for 70% stocks, 20% bonds, and 10% cash, while a retiree might prefer 40% stocks, 50% bonds, and 10% cash. Real-life investment example. Let's look at two investors. In 2000, John invested all of his money in one technology stock. Sarah invested in an S&P 500 index fund. Even in a market downturn, her investment has grown steadily over the past 20 years. Lesson: diversification and long-term thinking are the keys to successful investing. Today, we discuss stocks, bonds, and mutual funds, their differences, risks, and how to choose the right investment for you. Now, I'd like to hear from you. What are your favorite types of investments? Stock, bonds, ETF? Let me know in the comments below. If you found this video useful, don't forget to like, subscribe, and hit the notification bell so you don't miss out on our latest investing tips. Thank you for watching. See you next time.